Good morning. It's Tuesday, the 2nd of April, and this is Govindraj Ethiraj broadcasting from Mumbai, India's financial capital. This is not exactly a weather report, but I must tell you that heat waves are now being predicted for 10 to 20 days in different areas during the 3-month period ending June 30th, against a normal of 4 to 8 days, the Director General of the India Meteorological Department said in a briefing in New Delhi on Monday. So, we are likely to see above normal maximum temperatures over most parts of the country this summer. So it's going to be a one long and hot summer. And of course, it's also election season. And now our top stories and themes of the day. The markets have started strong in the new financial year and now await earnings season. The Magnificent 7 have become the Fabulous 4, lessons from Wall Street. China is buying up gold and determining global prices. India's auto sector continues to grow, and with it, the economy. Infosys gets a 6,200 crore refund notice from the taxman, decoding its significance. And India's companies are reporting better credit profiles. What does that mean going ahead?
This is a Crore report with Govindraj Ethiraj.
The stock markets open on a tear. The markets opened the new financial year on a strong wicket, hitting record highs, setting what many hoped would be the tenor and direction for the coming months. Interestingly, metal companies led the charge, jumping close to 4% after data showed that China's manufacturing activity expanded for the first time in 6 months in March. JSW Steel and Tata Steel rose almost 5% each and were the top gainers on the Nifty 50, and Hindustan Copper was up about 11% according to Reuters. More on China in a bit. The NSE Nifty 50 index was up about 135 points to close at 22,462, while the Sensex was up 363 points to close at 74,014. The last time both indices hit record highs was approximately 3 weeks ago, though on different days. Now, next week will be the start of the quarterly earnings season, as also, of course, the year end and full year results for India Inc. So, not only will we see the quarterly results, but we'll also see the full year results for the year 23-24. Now, this is important because it will provide fresh triggers to the market, both on the upside and maybe in some cases on the downside. Remember that many other macro factors, including political outcomes, have been factored into the prices already. Interestingly, the mid and small cap rally that had paused, crashed, or stalled, whichever way you look at it, as we mentioned in recent editions of the Core report as well, appears to have firmly resumed its upward journey. Small and mid caps, for instance, added about 3% and 2% respectively yesterday. Now, we've been talking about the rupee in general and its movement in recent days. Some figures are out. The Indian rupee overall depreciated in the last financial year by about 1.5%, which means it has largely held or been made to hold steady. The year before, by the way, it was down close to 8%, so it did better in 23-24, though it was still down. But the outlook for the rupee is generally good because of record forex reserves at $642 billion, as we pointed out yesterday as well, and steady foreign inflows expected into both debt and equity markets, the early signs of which we've already seen, apart from other flows like remittances and foreign direct investment, the last of which has been somewhat weak. But of course, the Federal Reserve, that's the United States Federal Reserve or central bank, being set to cut rates from June, that could reduce the strength of the dollar, which of course has been pushing down currencies world over, including the rupee. The Magnificent 7 becomes the Fabulous 4. You have to hand it to whoever comes up with these terms just in time to describe an entire market shift on Wall Street. In this case, we're talking about the tech companies. The news is not so relevant for the stocks themselves, which of course all have an India play in some way or the other, except maybe Tesla, but more importantly for how markets shift or keep shifting, and sometimes quite suddenly. The headline is this: the Magnificent 7 is losing its allure, or rather the 7 stocks together, the tech stocks, are no longer firing in the same intensity as they were until even a month ago. And yet, indices on Wall Street are still rising. The Wall Street Journal is reporting that S&P 500 climbed 10% in the first quarter, its best start to a year since 2019, even though 2 of its biggest constituents suffered double-digit declines. Apple shares fell 11% in the last 3 months, while Tesla dropped almost 30%. Tesla, of course, is an auto company, and you may wonder why it's a tech company, but that's a different discussion and not for now. Alphabet, which owns Google, shares were slow for much of this period before making a run in the last 3 weeks and ending up 8%. But the other four big tech stocks in the group, known as the Magnificent Seven, or earlier known as the Magnificent Seven, that's Nvidia, Meta Platforms, Microsoft, and Amazon, continued their strong run and outpaced the broader market. So now some market strategists are calling them the new Fab Four. Even if it's temporary and some of these things do shift very suddenly, this is a fascinating version of stock market Darwinism, I would think. So while Apple and Tesla have fallen back, various other sectors of the broader economy, that's the US economy, are obviously doing well. All of the S&P 500 sectors except real estate were apparently up in the first quarter according to the Wall Street Journal, and small caps, industrial and financial services stocks are amongst those that have done particularly well. Incidentally, the S&P 500's market value has risen more than $9 trillion since late October 2023, and the index has set 22 record closes in 2024, according to the Wall Street Journal. India's market capitalization, by the way, is around $4.75 trillion. Nvidia's shares have jumped more than 80% to start the year after more than tripling in 2023. And more interestingly, Nvidia is apparently even displaced or seemingly displaced as the most popular stock amongst individual investors. It's currently the biggest average holding in individual investor portfolios at about 9%, the Wall Street Journal said. And even more interestingly, the Wall Street Journal says that last year, any hint of weakness in any of the Magnificent Seven stocks would have sent the broader market tumbling. In fact, for much of 2023, these seven stocks were responsible for all of S&P's advances, or rather, most of it. But this year, despite Tesla's problems, that's current as well as forthcoming, as well as Apple's varying challenges, including on competition issues, the markets have been strong. So those are some of the takeaways from what's been happening on Wall Street. Of course, we don't know how it's going to continue, but watch this space. China is powering up gold prices again. China is buying up the world's gold. First, in India, gold futures hit an all-time high on Monday thanks in turn to record prices globally. Domestic gold prices or futures rose to 69,487 rupees per 10 grams. That's up nearly 10% in 2024, according to Reuters. India's gold imports are already set to drop by more than 90% in March from the previous month to hit their lowest since the COVID pandemic, a government official and other bank dealers told Reuters last week. Globally, gold rose to record levels on hopes, the market of course sees it as indications that the Federal Reserve is getting closer to cutting interest rates. Bullion has jumped to almost $2,265 per ounce on Monday, up about 1.6% from Thursday's close. So central banks like China are loading up on bullion. The nation's central bank has bought huge amounts of bullion to its reserves, boosting holdings in each of the last 16 months, according to Bloomberg. In addition, and very interestingly, gold buying is gaining in popularity amongst younger Chinese, said Bloomberg once again. It also added that JP Morgan Chase said last month that gold was its number one pick in the commodities market and projected that the price could touch $2,500 an ounce this year. Goldman Sachs said it sees potential for about $2,300 per ounce, thanks again to a lower interest rate environment. GST collections up 11%. India's gross goods and services tax collections, an indicator for overall economic activity, was up around 11.5% year-on-year in March at about 1.78 trillion rupees or 178,000 crores, the government's finance ministry announced on Monday. Now, this was the second highest GST collection ever, with the highest being in April 2023 at 1.87 trillion rupees or 187,000 crores. The government says average monthly collections, a slightly better figure to look at, for 23-24, that's the last financial year, were 168,000 crores per month, which was higher than the previous year's average of 150,000 crores. Car sales hit highs for the year. If indirect tax collections are strong, obviously goods like cars are selling more. All car majors have reported higher and mostly record sales for the year ended March 31st, 2024, as well as for the month of March, which just went by. The auto sector carries more than 50% weightage in calculating India's economic growth and, of course, reflects the strength in private consumption. I'm quoting these figures from Reuters. Also, as we've been reporting here, demand for sports utility vehicles has driven sales of overall passenger cars. Utility vehicles now reflect almost 60% of total passenger vehicle sales from April 23 to February 24, according to industry data. Industry leader Maruti Suzuki led the pack in reporting good numbers, saying that it crossed sales of 2 million units overall, including exports. Infosys says it will get a 6,000 crore refund. What does it mean? Shares of Infosys jumped 2% to a high of 1,528 in Monday's intraday deals after it said it expected a tax refund of up to 6,329 crore rupees. It said in an exchange filing on Saturday that it had received orders from the Income Tax Department for assessment years starting 2008 on to 2019, according to which it expects that refund, which also includes, by the way, interest. Infosys has said it was evaluating the implications of these orders on the financial statements for the quarter and year ended March 31st, 2024. However, Infosys was also slapped with fresh tax demands of close to 3,000 crore rupees, including for some of its subsidiaries. The fresh demands would obviously negate to some extent what the tax department will actually give to Infosys, but that's a separate issue. This, of course, raises a larger question. What do these refunds, particularly this size of them, mean, and what do they represent in terms of the nature of tax collection systems and the rather high amounts, like I said, involved? I reached out to Ajay Rotti, founder of Bangalore-based tax strategy and advisory firm Tax Compass, and I began by asking him how one could interpret these large refunds and what lay ahead for companies in the year ahead.
Govind, a refund like this would only mean one thing, that these were taxes which were paid in litigation, or what technically is called as against disputed taxes, tax paid in protest, as one may call. So what typically would happen is these are not refunds arising out of excess payment of advance tax, etc. Nobody misses their estimate and pays 6,000 crores more. And if you actually see the exchange filing of this company, it's for about 13 years that they've got this refund. And it is really very common, peculiar to the way tax litigation in India works. So what happens is the income tax department litigates and raises a demand for one of the years. And in India, you can't fight that without paying some amount of taxes, which is at this point at least 20%. So let's assume some other department raises issue and demands 100 crores, you pay 20 crores and then you litigate it. And as long as the litigation is open, the income tax department will keep carrying out the same adjustment in subsequent years, because they don't want to give up the claim, because a taxpayer can then argue that in the subsequent year you have not done this and therefore you have accepted my position, etc. So even in this case, it's over 13 years. I don't know what the issue is, but it will be the same issue that will have got repeated. Therefore, they would have paid 20% or so of every year. And once they win the case at a particular higher forum, one of the courts, then the whole money paid in protest comes back. That's what has happened here, because their disclosure is very clear that this is arising out of orders under Section 254, which is really an order pursuant to a tribunal order, which means there was a litigation and they won at the tribunal. It's as simple as that.
So what could be the overall demand if they've only been paying 20% and 20% and so on?
That is slightly difficult to guess. I'll tell you the reason. Is that in one of the years you may pay 20%, and after 4-5 years, if the issue is still open, the department may demand little more. The 20% is not codified in law. So as per law, you are supposed to pay everything and then litigate. The 20% comes out of an internal office memorandum where the CBDT has directed the officer that you collect only 20, higher in certain cases. So this could be higher or lower, but a refund of 6,000 crores over 12-13 years, the demand could have been significantly higher. And also these refunds come with interest. So the department pays 6% per annum interest. So there could be an element of interest also on refunds here.
Right. So in this case, the company in question got lucky because they've got the refund. What does this generally tell you, or where are we in terms of, let's say, the kind of assessments we've seen or we see, including high-pitched ones, and the refunds that we are seeing subsequently? So is there a ratio that you think is working? How favorable or unfavorable is it to companies who are usually served with such, let's say, higher pitched assessments?
So on higher pitch assessment, most companies end up paying a portion of it. There's no doubt on that. Very few get away with a 0% or a complete stay, as we call it. And in most cases, after they win at the higher level, the refunds do come back. But really, the time taken is anybody's guess. Currently, there is some discipline in the department because anything beyond giving effect to the order of a court beyond a particular period, the officer has to offer explanations, etc. So they've been processing these refunds slightly earlier than in the past, I would say. But these take months to years for these refunds to come back, and that depends on the issue at what level you are. In terms of your other part on collections, etc., this is something that we can actually notice whenever their direct tax collections are disclosed by the government. They are always net of refund. So the refunds issued also will be an amount. The government clearly follows tax basis. So if they raise a demand this year, collect 20%, only 20% gets accounted as tax revenue. When it gets paid back, it gets adjusted in the year in which it is paid, insofar as the government is concerned.
What heads do you think companies are likely to be, charged under? Not maybe charged is not the right word, or served such tax notices under, typically, from your experience?
These would be the regular. So when you file your return, the return gets scrutinized and the assessment order is passed. These would be under that. Or, in the disclosure that's been made, the company has also got a demand on account of non-deduction of tax, or the department believes that they have not deducted taxes at source. So it could be on variety of this, but most of it would be because of their normal tax liability, which is disputed. You file a return with declaring tax liability of 100 crores, the department believes it has to be 250 crores, for example.
Okay. And any broader takeaways, Ajay, as you look ahead? I mean, we've just ended one financial year and we've just begun the next one. So from this, for companies and how they manage their taxes, either in general or specific?
I think most companies today keep a close eye on how much of their tax is stuck in litigation, because in most cases, because the demands are frivolous or the company believes that they have a strong case, they don't really provide for these as liabilities in the books. Therefore, when these refunds come, they don't really become an income. These are carried in the balance sheet as taxes receivable or tax paid under protest receivable. So it's more of a working capital management. Most companies that I work with keep a very close eye on this, follow up, get cases heard quickly, don't take adjournments, etc., so that some of these can be liquidated. That's the only thing. But, this is one bit of thing that everybody who litigates on taxes in India is aware of, most corporates, including the MNCs, that there will be some amount that will be paid under protest and litigated. Therefore, it comes back. The only saving grace, if I could use that phrase, is really it comes with interest.
Ajay, thank you so much for joining me.
Pleasure.
Credit quality improves for companies ahead of a capex cycle surge. Healthy balance sheets of companies eventually translate into a healthy economy, at least the private side of it, or for that matter, even state-owned companies. Right now, this is also seen as an important precursor to imminent investments in growth and expansion, particularly involving debt. But strong balance sheets, whether of companies or industries, are also an important benchmark to assess stock market strength and prospects as well. So do stay on for this slightly longer report. So Indian companies continue to see good credit quality in the last 6 months thanks to deleveraged balance sheets, sustained domestic demand, and government-led capital expenditure. Rating upgrades continue to surpass rating downgrades in the second half of last year. In all, there were 409 upgrades and 228 downgrades in the second half of last year, according to rating agency CRISIL. Finance companies, which one would have concluded are under some stress, are actually doing quite all right. The credit ratio, an important ratio to watch, and we will come to why shortly, was down slightly to 1.7 times in the second half of the last year compared to 1.9 times for the April to September 2023. That's the first half of last year. In any growing economy, the question to obviously ask first is how healthy are balance sheets at this point, and second, how well are they placed to borrow for capacity expansion in specific and growth in general, which could include working capital if they so desire to borrow. CRISIL says that revenue of the upgraded companies grew around 13% last year, largely thanks to a pickup in volumes. So with balance sheet in most sectors at their healthiest, capacity utilization around peak levels, and expected interest rate cuts, a broad-based pickup in private capital expenditure is in sight. Looking ahead, some 21 of 26 corporate sectors tracked by CRISIL have strong to favorable credit quality outlooks, which in turn is marked by robust balance sheets and good operating cash flows, expected to be as much, if not higher, than last year. Sectors with a better asset quality outlook include auto component manufacturers and hospitality, which includes hotels, I would imagine, and education sector companies where credit quality is also matched with healthy domestic demand. CRISIL said it covers sectors benefiting from the government's infrastructure spending, such as construction companies and steel, cement, and capital good manufacturers. However, on the other hand, sectors that could be in for some tough times include specialty chemicals, agrochemicals, textile, cotton spinning, and diamond polishers, largely because of global macroeconomic headwinds. On the flip side, even for these sectors, the balance sheets are relatively strong and hence the outlook is stable to moderate. So you could be a good company in a somewhat weak sector. So, for more on this and some insights, I reached out to Somasekhar Vemuri, Senior Director at CRISIL, and I began by asking him what these new sets of numbers and their study was telling us.
Essentially, we convey our credit quality trends through ratio called credit ratio, where we consider the number of upgrades that we have done in relation to the number of downgrades that we have done. And in the second half of last fiscal, we saw this number 1.79 times. On a comparative basis, we had 1.91 for the first half of the previous fiscal, and hence that represents slight moderation. If we go a little further back, the numbers used to be upwards of 2.2 times, in fact, even 3 plus times just after, India started getting out of COVID. Essentially, because a lot of the companies which were recovering, they were using their cash flows primarily for paring down the debt from on their balance sheets. And hence, there was very sharp improvement in the credit quality that point of time. Also, you had a lot of these, the relief measures coming in from the regulators and the government, emergency credit lines, which are guaranteed. You had moratoriums, you had restructuring windows which are open. So all of them also elevated a lot of these pressures. Over the last about 3 halves, we are slowly getting into a normal kind of environment where impact of the effect of some of this COVID time measures is waning off. And historically, if you see, we used to operate at a 10 year, if you look at a 10-year average upgrade rate, that's about 10.7%. And, our downgrade rate used to be around 6.7, 6.8%. We are seeing numbers coming closer to what we have on a 10-year average basis.
When you say you have a 10.7% upgrade rate, what does that mean?
So if you look at last 10-year period, on an average, if we had 1,000 companies, for example, on the portfolio at the beginning of a particular half year, we would see 10.7% or about 107 companies seeing upgrades on an annual basis. So roughly about 53 companies in the first half, which would see upgrades. And likewise, if you see on the downgrade side, about 6.8% annualized. So about 68 companies on an annual basis, vis-a-vis, and 6 months, it will mean about 30, 35 companies are the ones which are seeing downgrades. That's the historical 10-year average that I'm talking about. What we saw in the second half of previous fiscal, the upgrade rate was about 12% and downgrade rate was about 6.7%.
And you have 409 upgrades and 228 downgrades right now from a portfolio of roughly 7,000 companies. Now, can you tell me how this links to the health of the company's balance sheet right now and its ability to either borrow or borrow cheaply as it might desire at this time?
So what we have also seen, this is what has happened in the second half of last fiscal. What we have also seen is, if we were to look at it on a forward-looking basis and figure out what is our outlook going forward for the next 1 year or so, there as well, we are seeing the credit quality outlook to be, positive, and we expect upgrades to outnumber downgrades. Though the trend of normalization may continue for some more time, and we may see from 1.79 times maybe a little bit more of moderation, maybe not too much, but some degree of moderation is possible. And the drivers for that continue to be the robust domestic demand, which continues, the low corporate leverage levels which are there. If you look at the average gearing is debt to equity kind of a ratio. It's a multi-decadal low, when up 0.4, 0.45 times. It's fairly on the lower side. And if I look at interest cover as another indicator on the financial metrics, that also more than 5 times is fairly on the higher side. I'm looking at the median for the portfolio of these 6,500 odd companies that we have. The headwinds is primarily coming from the global side. Uneven global recovery could cause some bit of issues for companies which are in the export side. And any elongation of the Red Sea crisis could result in supply chains becoming a little more elongated and could cause profitability related issues for some of the exporting.
But at this point, you're saying that overall, and even if you were to look at it, like, let's say over a 5 to 10 year period, the balance sheet of companies are much healthier than what they were because of the low debt levels on them. And that also gives them the ability to obviously borrow if they want to, and perhaps cheaply. And then you're saying that, however, within that, there are companies or sectors which are still facing headwinds, which are in the form of, let's say, those who are export oriented and so on.
Absolutely. Just to share some numbers, median gearing used to be about 1.1 times by the end of fiscal 15-16. Gearing came down to about 0.97 times by the end of fiscal 18. When I look at fiscal 24, our estimate is it would be around about 0.45 times. So if you look at over a span of time over the last 10 years, there has been a trend of deleveraging. The corporate India has been on the sidelines in terms of major capacity expansion. They've not embarked on that. That's the reason for lower leverages which we are seeing. So we do anticipate annual capex growth of about 9 to 11% over the next 4 fiscals across both the manufacturing segment as well as on the infrastructure side. And we believe that the balance sheets have enough headroom to take on debt for funding this capex without much pressure on the credit quality at this juncture.
So if you were to look at how companies have been either borrowing or not in the last couple of years, would you say that the propensity to borrow might return? I mean, even going by, let's say, the number of queries or rating queries that you're getting, or any other indicator that helps in understand this?
So essentially, companies would borrow for a couple of needs. One is the working capital need because of novel growth. And then the second is for capex or organic growth. On the capex side, we do believe that finally we are seeing that the corporate India will start spending, and hence we will see some element of investment in capacities as well as debt which will come on. On the working capital side, it was much higher in terms of the need when the inflation levels were fairly high. The commodity prices were fairly high about year and a half back. Commodity prices are softening now, so the working capital demand is not as high as what it was earlier. It continues at a reasonable pace. It was not, as high as what we saw, in the hyperinflation period just a couple of years back.
So thank you so much for joining me.
Thanks. Bye-bye.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.